Welcome to the Mortgage Interest Rates Weekly Update for the week of January 18th, 2016. Hello, I'm John Thomas with Prime Residential Mortgage, here to give you an update. Well, last week was certainly kind to mortgage rates. Mortgage rates were able to move lower to end the week. Take a look at the bond chart on the screen. You can see there the bond has traded up to the upper end of the trading range. We've had a nice rally since the last week of December. We've been able to rally up, break through some different points of resistance, and we're at the upper end of the trading range. And what's helped us do that was basically the new year started off with the stock market selling off, tried to recover, couldn't recover, sold off again last week, and bonds went all the way to the top of the trading range. Now that looks like good news. Mortgage rates moved down, but we only were up 19 basis points on Friday when we closed. That's in the face of the Dow Jones Industrial Average dropping 390 points. That is not good. If the Dow drops 390 points, we'd expect mortgage bonds to go up by maybe 100 basis points. So with that in mind, if the Dow reverses course this coming week, we would see a sell-off in the bond market and would drop back down. You would see interest rates move up. So with that in mind, we're going to recommend locking in your mortgage interest rate right here. Take advantage of what you got last week. Interest rates moves lower. Lock it in. Take advantage. Don't be caught off guard with the stock market might rally and pull money out of bonds. So if we dig into the economic news, what's going on with the stock market? Why is it selling off to start the year? Well, two big things. The first one, price of oil keeps dropping. We were already down to the $30 a barrel at the end of the week last week. And then big economic slowdown in China. So those two things are worrying the stock market, causing it to sell off, and pulling money out of the stock market into bonds has helped mortgage rates. Now, the U.S. economy, contrary to what the press is saying, is not really doing that well. We are starting to slow. A big report on Friday showed that the New York manufacturing data came out, and that was a dismal report. And that's a leading indicator of production, so that does not bode well for the U.S. economy. We saw employers stating they're going to do layoffs and store closings. The big one on Friday was Walmart announced they're going to close 269 stores, laying off 16,000 people. 10,000 of those people will be here in the U.S. And there's other layoffs being spoken of too from other companies. So that is not a sign of a U.S. economy doing well. And then another signpost that the economy is slowing is the gross domestic product with the GDP for the third quarter of 2015 was 3.9%. Well, the GDP for the fourth quarter of 2015 dropped to only 2%. That's not the sign of an expanding economy, that's a sign of a contracting economy. And then we saw retail sales for December 2015 released. We were expecting retail sales to go up by 0.1%. They actually dropped 0.1%. Huge reversal of the data there. So retail sales for all of 2015 only rose 2.1% for the entire year. That's the smallest increase in the entire current economic recovery since 2008. So that's not good for retail sales. So what's going on? Well, people are saving money at the pump. Gasoline has dropped very low. I just saw it at $1.77. Well, instead of people taking that money and spending it on holiday sales, they were actually saving it. So that didn't bode well for retail sales, which doesn't bode well for an economy. And then we saw weekly initial jobless claims released on Thursday. Claims jumped by 7,000 to 284,000 claims. That's the highest level since July. But all in all, there's still a good report there because it's the 45th consecutive week of claims being below 300,000. But we need to watch and see if these corporate layoffs like the Walmart layoff is going to start moving that number up above 300,000. If it does, that's going to be bad news for the labor markets. We'll keep an eye on that. Now, in housing news, some great news for housing. CoreLogic released their national foreclosure report for December 2015, and it showed foreclosures dropped 21% from the previous year. Previous year, there was 573,000 homes in some kind of foreclosure. This year, there was only 448,000. So that's great news there. And only 3% of all homes are seriously delinquent, which is the lowest level in 8 years. So what's the outlook for housing for 2016? Well, I believe it's actually very good. Even if the stock market continues on this rocky start and sells off and we have a correction, I don't think that's going to affect housing because the fundamentals of housing haven't changed. We still have extremely low inventory, rates are really low, and we have a lot of buyers that want to buy now that they're working and home prices are good and rents are going up. So that's still going to put an upward price pressure on homes. We're still going to see a national average of home price appreciation around 5% just like this year. And mortgage rates are going to stay low. with the stock market selling off, the Feds aren't going to be able to keep raising the Fed funds rate. And the stock market selling off is going to move money into bonds. World economy slowing down. Investors are going to invest in the safe haven, which is U.S. bonds. That's going to keep mortgage interest rates at record lows for 2016. So it's still going to be a great year to buy a house, even in the face of a bad economy. So get out there and buy. In the local news, we've got a first-time homebuyer seminar coming up Saturday, January 3rd in Dover, Delaware from 10 a.m. to noon. That's at the Dover Holiday Inn. And then the next one in Newark is February 20th from 10 a.m. to noon at the Christiana Hilton Hotel. You can register for either one of those events, but give us a call in the office, 302-703-0727, or online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.